By understanding the factors that can influence financial decision-making, you can make good investment decisions. The first one is to have well-defined financial goals and sorting these goals into short-term, medium-term, and long-term. Take for example, this 20-year-old aspiring artist, or this 35-year-old family man whose needs are different. Or maybe this young dynamic working couple who want to start their own business in the next 10 to 12 years. Goals and priorities vary for different individuals, and identifying them should help set the base for your investment decisions. The second key influencing factor is time. Understanding how much time you have to achieve your financial goals can help you plan better. For instance, a young couple may want to work for someone else for another 10 to 12 years while they save up enough capital to start their business. So they can take some risk by investing in products like stocks or shares or equity mutual funds, as they want to earn a lot of money and also have the time to recover in case anything unexpected happens to their investment. If, however, they want to start their business within the next 3 to 4 years, the risk they can take with their money will be much lesser, and hence the choice of investment will differ. In general, you should invest in products that carry lower risk when you have a shorter time horizon, but should be looking at products which help you create wealth even if they carry more risk if you have a longer time period left to plan. The third key influencing factor is your risk profile. It helps you determine how much risk you can take and where you can invest based on various factors such as your age, income, wealth accumulated so far, number of dependents, mental makeup, and so on. Risk profile is an important determinant of the kind of investments one can make, and it varies significantly from person to person. Some people may simply have a greater appetite for risks. This means what your colleagues are doing with their money may simply not be right for you, so don't copy them blindly and act on tips. The fourth factor that may influence your investment decisions is your own emotions. Certain investments like stocks and shares are linked to market movements and hence are prone to fluctuations. One day they can give you great returns and you feel very happy, but the very next day the value may fall and you may get really worried. The secret is not to panic and react to everything that happens in the market and stick to a well-defined plan. After all, if you're smart and are thinking long-term, then act long-term as well. Don't forget to account for unexpected events while making investment choices. This helps you remain on track during rough times. While most of the factors we have spoken about till now are about you, you also need to be aware of external factors that can influence your decisions. For instance, inflation can affect the real value of your investments. Rising prices eat into your investment value, so you always need to plan to stay ahead of inflation. Economies have cycles of high and low growth, which can impact the speed with which your investment value multiplies. Lastly, even the government's stability and its policies affect the market and consequently your wealth and investments. So now that you understand the many factors that can influence your financial decisions, you are well on your way to become a smarter investor and make great investment decisions. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.